Welcome to the Explainer. Look, today we are zeroing in on the newly introduced USD1 stablecoin. It's got massive appeal right now, especially if you're a yield hunter. But we're going to dive way beneath the surface of our source material today to uncover the hidden financial and, frankly, technological risks that are actually keeping this digital dollar afloat. Let's get right into it.
All right, so here's our roadmap. We'll start by meeting the USD1 stablecoin, look at earning in a bear market, then break down the mechanics of the peg, explore the hidden plumbing and liquidity, and wrap up with tech vulnerabilities and risks. Section 1. Meet the USD1 stablecoin. Okay, so I want to start with a question that's probably been on your mind lately. How on earth do you earn an 11.2% yield in a down market without exposing yourself to the crazy, wild volatility of altcoin pumps? You know, when the market is just dragging, finding a safe haven that's actually still pays out, it's honestly like finding water in a desert.
Well, the answer, remarkably, was simply holding the USD1 stablecoin. Seriously, by using Binance yield farming over a recent 6-month stretch, users who just parked their funds netted a highly effective 11.2% annualized compounded return. No trading, no stressing over timing the market, just holding a stablecoin.
So what exactly is this asset? USD1 is a fully collateralized stablecoin issued by World Liberty Financial, and it operates natively across multiple major chains. We're talking Ethereum, BNB chain, Tron, and Solana. It achieves its one-to-one peg to the dollar using super conservative, regulated backing, things like cash, cash equivalents, and short-duration U.S. Treasuries. Now, our sources do note its connections to the Trump family, but taking a totally neutral look at the actual operational structure, it's really just a straightforward, traditional mint and redeem model.
Section 2. Earning in a bear market.
Looking at the breakdown here, the math behind that return is pretty fascinating. You can see over 5 rounds of WLFI holding rewards on Binance, combined with a flexible savings booster right at the start. The yields fluctuated, sure, but they stayed incredibly strong. Let's put that into perspective. If you started with an initial 10,000 USD1, your balance rolled over, compounded through these phases, and grew to over 10,506 USD1 in literally just half a year.
But what's really striking is the contrast. During this exact same 6-month period, laying flat and earning that safe, let's call it a 5% net half-year yield, completely crushed more aggressive crypto strategies. I mean, going long on Bitcoin during that same window, that resulted in a massive 28.2% unrealized loss, and Ethereum, a brutal 43.5% drop. Sometimes, honestly, just avoiding the churn and finding a safe place that yields consistently is absolutely the smartest play you can make.
All right, Section 3. The mechanics of the peg. To really understand the plumbing beneath all this, we have to talk about the 2025 Genius Act. Because, you know, Washington loves a good acronym. This established the very first comprehensive federal framework for stablecoins in the U.S. It mandates strict one-to-one backing with safe assets, so no algorithmic tricks allowed here. This is legally designed to guarantee that one USD1 token can always, without fail, be exchanged for exactly $1 US. So, the absolutely crucial point here is how the money actually moves. Think of it like this. When you mint a stablecoin, central bank reserves shift from your bank to the stablecoin issuer's bank, who then buys a Treasury security. The fascinating takeaway? The total volume of bank deposits in the entire financial system doesn't change at all. The money literally just shifts accounts behind the scenes, while your digital token magically appears on the blockchain. But here is where we hit a massive, massive conceptual difference that our source material really emphasizes: solvency versus liquidity. Look, solvency simply means the issuer has the assets, right? The value of their treasuries equals the value of their tokens. Good. But liquidity means being able to sell those treasuries fast enough to pay users actual cash the exact second they click redeem. And as we're about to see, those are two entirely different things when the market is under stress.
Which brings us to Section 4, Hidden Plumbing and Liquidity.
Let's take a look at the redemption flow. When you want your dollars back, the issuer can't exactly just mail you a tiny fraction of a treasury bond. They have to actually liquidate those treasuries through broker-dealers in the traditional financial markets to get those bank deposits. Which means, and this is super ironic, your lightning-fast 24/7 digital crypto redemption relies entirely on traditional T+1 settlement markets. Markets that, you guessed it, only operate on standard banking hours.
Now, if we compare stablecoin issuers to commercial banks, the risk profile is completely different. Stablecoin issuers are way more exposed to sudden bank runs. Why? Well, because almost all of a stablecoin's liabilities are demandable, meaning users can ask for their money back immediately, all at the exact same time. Banks, on the other hand, have non-demandable liabilities, like long-term savings accounts. They have strong capital equity cushions, and crucially, they have direct access to the Federal Reserve to borrow money in a pinch. Stablecoins? Yeah, they just don't have those safety nets right now.
And you can see that clearly when we look at leverage ratios. Major stablecoin issuers historically run with incredibly thin capital buffers compared to regular banks. I mean, while traditional banks are legally required by regulators to hold significant leverage ratios just to absorb losses, stablecoin issuers, they basically rely almost entirely on the hope that their assets remain perfectly liquid. They don't have these massive capital cushions to fall back on. They literally rely on the broader market's liquidity to survive a stress event.
And guys, we know for a fact that these underlying Treasury markets can and do freeze up. Just look at September 2019 when repo lending rates spiked out of nowhere, or the absolutely terrifying March 2020 dash for cash. During that 2020 event, there was a $500 billion surge in Treasury trading that just completely overwhelmed the broker-dealers. They literally hit their balance sheet limits. They couldn't process the trades fast enough. This proves that even the supposedly safest assets in the world can face severe intermediation bottlenecks. If a stablecoin run happens to line up with a market freeze like that, your redemptions could stall entirely.
All right, last part, Section 5, Tech Vulnerabilities and Risks.
So USD1 operates natively across Ethereum, BNB, Tron, and Solana. And hey, this multi-chain approach is absolutely fantastic for users because it gives you incredible flexibility and speed. But it also introduces some really unique operational risks that traditional finance just doesn't have to deal with. We are talking about potential smart contract logic bugs, relying on Chainlink oracles to report off-chain data, and of course, the ever-present threat of cross-chain bridge exploits. A failure in any one of these software layers could completely disrupt the stablecoin, even if the actual treasuries sitting in the bank are perfectly safe. It is literally a chain that's only as strong as its weakest digital link.
Ultimately, there's a comprehensive academic paper in our source material that captures this perfectly. It says that maintaining par value redemption depends not just on backing asset quality, but on the functioning of Treasury and repo markets, the capacity of broker-dealers, and the operational reliability of the blockchain itself. Basically, stablecoin safety isn't just about what's sitting in the vault. It's this highly complex, interconnected web of traditional market function, Wall Street dealer capacity, and the absolutely flawless operational reliability of the software.
Which leaves us with a final, pretty provocative thought to consider. The next time you're sitting back earning that sweet double-digit bear market yield, remember this. The token itself might work beautifully on your screen, right? And the assets backing it might be absolutely pristine. But what actually happens when the hidden traditional financial plumbing beneath all of it gets clogged? Something to think about. Thanks so much for joining me for this explainer, and we'll catch you in the next one.